Hey guys, Mike here. So, got a jam-packed week coming up. Got a boatload of data in this, as I was unable to do Friday's video because I was on the road coming back from Alabama. We finally made it back home, as you can see. So, good to be back in a much warmer environment. I will tell you that. I certainly missed it. But boy, it is interesting what is happening in the market right now, of course. And I personally laugh because I always tell you guys that, you know, when it comes to manipulation, there's just no shame, right, in the market. And I always say it's funny, as soon as you start to see that weakness creep in, what these rating agencies do and these hedge funds and stuff like that start to do to try to really just push these stocks down, right? And again, you know, a lot of people, they get upset when they see red, but I'm like, oh, would you really rather be buying at all-time highs or buying at a discount? I don't know. To me, it's kind of obvious, I guess, but you know, some people do get very upset because your portfolio starts to take a hit, but it depends on your horizon. Or if you're in options for a weekly option, you're in trouble. But if you're looking out, planning on holding the stock for 3 months, 6 months, a year, 2 years, whatever it is, you know, it's not really that big a deal. But there are certain things you need to be aware of that is coming up and that is happening currently if you hadn't seen it yet. One thing you can start hearing a lot more about is the government shutdown that could happen coming up. I believe it is January 16th, I'm not mistaken, but this is going to be interesting. And remember, shutdowns normally don't affect the market. The problem is going to be if you get a downgrade to government debt, because what do we know is happening this year? It's going to be another record amount of bonds being issued to pay for all the spending these idiots in DC are doing, okay? Now, what else is happening? Boy, downgrades all over the place for major stocks, okay? You're seeing them just pounce on these stocks. As soon as they show weakness, they're putting it in. Like all these are just for the fifth. I can show you the fourth and third too, but it was a boatload of downgrades. Now, we had a lot of economic data come out, which also caused something else to happen. What happened? You had the jobs data come out. It was hotter than expected. The unemployment rate did actually end up at 3.7 versus 3.8 expected. Average hourly earnings end up being higher than expected, but usually they actually downgrade or actually mark down those jobs that were created. They've done every other month. And you can see, look, this is another thing people are trying to put out there. Look at the number of jobs where it's multiple job holders. But when you pan to the left, you're like, wait a minute, in 2019, I mean, we're just right above that level, obviously. But when you look at 2018, I mean, we're not that much farther up. And, you know, I'm sure there's a good reason for why people are holding multiple jobs. And we've talked about it before. There's two different economies. Maybe there's not many full-time jobs. The businesses are cutting back on hours. That kind of stuff, right? But it's not like it's some crazy extreme. When you look back over pre-pandemic, you can see that, right? Now, you look at the ISM Services PMI report came out. This is employment. Look where it's at. Not even the dot-com bubble reached that level right there. This is a major contraction. That was a big drop, by the way, when it came down. So only the two times it's been lower than this was during the great financial crisis and then during 2020 when we shut down the world and people weren't allowed to go to work. And more importantly, how was the market, you know, receiving this, right? Because then you go over to the manufacturer's new orders and you go, well, that's pretty good, man. That's not too bad at all, right? Had a nice little pop-up, nice little recovery from the last report. But again, you know, new orders are still in contraction, as I showed the members in the video before. The manufacturing, industrial stuff, the data, it really doesn't look good at all. But again, we're 70% services. So they're like, well, you know, maybe it's going to recover. Maybe this is a new cycle moving up when the Fed cuts rates, right? So they're trying to tell you, and this data is what is affecting this right here. This is March, right? What was supposed to happen? You're supposed to have rate cuts starting in March, but I think all of us are like, dude, if we're not in a recession, why in the world would they be cutting this stuff? But again, it's about this soft landing. Everybody's going to be employed, but the job market's not going to be too hot and all this good stuff. But when you look and this data starts coming out, all of a sudden they're like, maybe they're not going to end up cutting, right? Because when you scroll down, all of a sudden, if you look, this went from 73% down to 62%, which it'll probably continue to drop as we get closer to March unless some crazy data comes out, right? And so again, and then all of a sudden to keep it the same, that went from 11% to 33%. So they're like, well, maybe they're just going to hold, which we pretty much know they're going to hold, right? And a lot of this is what's leading to this right here. And guys, before we continue, please hit that thumbs up button. I really appreciate it when you guys do that for me. It helps people find the video, which a lot of new people have been. And if you like the content, think about subscribing. I appreciate all your support. You got the S&P trying to come down right here, trying to maybe bounce off this fair value gap right here to get a reaction, maybe not go down to 4,600, which a lot of people would call for, which is a lot of support right there. If it does, again, not a whole lot of momentum, as you can see by the RSI. Obviously trading below 50 right there, starting to head down, people still selling, and really volatile during the day, right? You'll have it go green, all of a sudden it goes back red and all that. But when you look, and we'll go over here to this daily right here real quick, you can see we're trying to hold the 21 EMA right now, because if the 8 crosses the 21, you can see every time this has happened, going back to August and usually every other time, you get a real nice pullback, which means we'll definitely probably head down to at least 4,600 for sure, which would be a key level, as you can see, because that was the level back there in November, it was the level back in July. And so that's something to keep an eye on right there to see if we can finally start to get some momentum, because on the daily, the RSI is holding up. It hadn't crossed the 50, all right? And one thing that's good for the S&P is when you look at HYG, right? If smart money's still buying in because it's been selling off, it's in this fair value gap. It's starting to try to hold to get a bounce, because remember, if it cuts through that, it's going to be a hot knife through butter. Well, maybe you get a bounce around 76, which would be key right there. Again, 74.50 is a whole lot more support. And you can see it's trying to hold that RSI and MACD, even though you got a bearish MACD cross. But the thing you're really looking for here is, one, again, this is a bond ETF. Like, it got overstretched from its 200. The rubber band effect is pulling on. Because when you scroll back, you can see it doesn't get, when it's above it, you see when it's crashing, but when it gets above it, like, that's 5%. Like, and we're going back here 2 or 3 years. It's not one of those things that gets stretched way out above the 200 moving average. In this case, it did. Okay, but the good thing is when you add on the S&P to this right here, you can see they're still in lockstep right now. So there is no divergence, right? And the S&P is selling off, HYG is selling off. There is no divergence at all right now. And when the divergence happens, it can usually take place for quite a long time. So we'll have to see these stay in lockstep, okay? So that's actually a good thing, believe it or not, if you're a bull. Now, when you go to IWM, and this is what the rate cuts are affecting more than anything else. That's why you've seen IWM struggling. Breaks that trend line, comes down to this fair value gap right now. So now we get to see it's starting to get a reaction. So it didn't cut through it the other day. And so we'll have to see if this holds up or not right here. When we bring up the MACD and the RSI and all this fun stuff, you can see, obviously, it's holding the 50 on the RSI. If it drops below the 50, it's going to be, I think, even more trouble, to be honest with you. And drop down to probably, maybe you get down to 190-ish, somewhere there if that's the case, but it doesn't respect this fair value gap. But also, again, that trend line that was above, well, that's going to be resistance now. Okay, so just keep that in mind if it does start to move up. And this is why, no surprise, you're starting to see what? Money kind of rolling back into the Mag 7, right? You saw NVIDIA and all these others, Meta, like, move up, and you saw PSCT, which is small cap technology, dead last for the last couple of days, really. And when you look, why would they do that? And this is what we got to watch very carefully. If they don't think they're going to cut rates, they'll pile back into these big mega cap stocks, because why? The balance sheets. This is what happened last year. This is why they piled into them, because they got so much cash, and the rates, they actually make so much money. As I showed you, Microsoft and Google make hundreds of millions off of the rates being higher, off of the investments with their cash, because they have so much of it, right? That's why Apple kept getting pushed up. So watch and see if you see a rotation. If they don't think those rate cuts are going to happen, that's probably what you're going to see. Just to keep that in mind, all right? Because especially when it comes to earnings, I mean, their earnings should be way better than the small caps. Now, also affecting the small caps is just the regional banks. This has been selling off. No surprise there. Again, if it breaks that trend line, then if that breaks the trend line, starts moving down even harder, IWM will move down even more. Okay, so just let's keep that in mind. Also, one thing you see on mega caps, they're at major moving averages. We talked about the Apple just last week, about that 200. There it is. It got its bounce right there, as you can see. It respects its 200 moving average. Don't mean it can't dip like slightly below what you see right there. But again, it got its bounce off of that. And again, when you pull back and stuff, and we try to put this on the logarithmic chart, there is that trend line we talked about, which has been there since 2003. Okay, we hadn't hit it. It's right below it, so it's only 177 if it got down to that. And so that's what we'll have to see if it holds or not. But again, I'm going to show you, you're seeing a lot of these mega caps are setting at major moving averages right now on the daily and getting bounces. We move over, you see the Microsoft here. Microsoft, which to me is a much better company than Apple at this point in time, is setting it as 50. It got a bounce, not only at the 50, But that support level right there, which was, again, all-time high, now it's coming back down, trying to turn it into support, which is a good thing for it. Again, if it breaks that 50, though, then you can see another $10 drop on Microsoft. But the one thing to pay attention to is, again, you're looking for anything you can get on this in the shorter term time frames like the hourly. You see some bullish divergence, right? Where this upstairs is going down the RSI, it's going up, which means the bearish momentum is slowing down on the lower time frames. And again, when you're looking at 4 hour and the daily, that's not the case yet. So let's wait to see if that plays out. Now, Tesla basically just stuck in this range right here. It's good for $5 a day, it seems like, with the range. Anywhere from 236 to 244 right there over the last 3 days. Again, that prior day's low end up being resistance at the end of the day. Still hadn't reached its 50 or 200 yet. We go to the hourly. You can see, though, a little bit of bullish divergence on the lower time frames, right? Selling momentum maybe starting to wane a little bit. A lot of support between 225, 233 right there. Again, that 200 moving average, if we break that, there's definitely going to be a lot more hurt in mine. But again, looking at this, it's going to have a lot of resistance, right? You're going to have that 100, still a brick wall. Both those trend lines now are resistance, okay? So a lot of red stuff going on Tesla. Again, it was the laggard, then became the leader in the Mag 7, and now it's just getting hammered back down, and the other Mag 7 are starting to kind of take off, right? Amazon, where's it setting? At that 50. That's where it got its bounce, right? You got that support line right there, is right there below it, which now is some kind of resistance, but we'll see if the 50 can hold. And you can see, again, each stock really respects a different moving average. That one, since September, you can tell it loves that 50 moving average, right? So we'll see if that can hold up. You get that bounce. That ascending trend line will be resistance now, just FYI. Palantir, we talked about going down to 15. If it broke that level up there, which it did, broke that 100 moving average, broke that trend line. There was a lot of confluence there, and there's that RTH gap from earnings. And of course, what helped this move down to almost 15, we'll see if it gets all the way down there, is a downgrade, right? You're seeing many of these across the board. So it's calling this basically an overhyped fake out on AI. We'll see if that plays out or not. But again, none of us are surprised we're going to that level. We talked about it weeks ago. PayPal is another one here, right? Set that a moving average, gets to that 50. Everybody's loving the 50 right now. Ends up falling out of this channel right here, but it gets down to 50. Has a nice little bounce right there. Again, 60, 76 is resistance. We talked about that 200 moving average, that trend line. That's just going to be a mess. I'm going to extend that ascending trend line up because all of that's going to be resistance now, especially with the 200. So that'll be a beast to get back through. And fintech's just getting hammered all around. But the one thing about when you look at PayPal, what hadn't hit, it only got one downgrade. It got 2 downgrades, okay? So it's just this big onslaught of downgrades. As soon as you see weakness, they just pile on it, right? Because they want to be able to pick it up at a cheaper price. It's that simple. Because you didn't see them downgrading any of these kind of stocks when we were moving up in December, did you? Right? Why? Because it would have done no good. There was so much momentum behind all these stocks, moving up, Apple, everything else. They would never be able to mess with them in November, December. But as soon as they see weakness, oh, we got downgraded because now earnings might not, the AI stuff, well, all these concerns that could have been talked about in November, December wasn't talked about. But again, you'll see it a lot. Pay attention to that. As soon as you start seeing that red, you go, uh-oh, where's the downgrades coming? That's why if we continue to go down and we start to have this fight in the government, and they want to shut it down, this is when you got to look out for the rating agencies who are bought off and paid for to come out and downgrade America's debt, right? That's when you got to look out for it, not when everything's going good, okay? Now, we do have some earnings. Going to have some big earnings coming up this Friday. We're starting to kick it off again. When it comes to smaller companies, Tuesday, you have Tilray. These kind of companies have been getting a lot of talk and everything. You go over here to Albertson, which is food shopping. We'll see how we're doing. And talking about the consumers, KB Homes, big home builder. It's amazing how much a lot of these home builders have moved right now. And then Friday is the big day. You can have all your big financial companies, also Delta on there reporting. So this is when we start to kick it off and see what they got to say and what their projections are for the future and how we're doing and how much money we've saved in the bank and all that good stuff is what we get to look at. And then data-wise, not really a lot, right? Monday, nothing really to speak of. You'll have a lot of Fed presidents out because the blackout window is over, out there running their mouth. NFIB, business optimism. Some people might pay attention to that. Red book year over year, but not much. Wednesday, you come out there, you got a lot of mortgage data, which, maybe somebody starts to care about, the oil data and everything. Maybe you do have a 10-year note auction, which we'll pay attention to, I guess. So far, they've been going okay, right? And we're going to have a lot of these, I guess, because we got a lot of debt issue. Got to wait till Thursday to get the real data, though, right? You're going to have a lot of jobless data coming out, core inflation month over month, year over year. On month over month, they expect to drop. Year over year, they're expecting to drop as well. So we'll see if that comes out good for it. And then, of course, you'll have regular CPI and then inflation rate month over month, year over year as well. And again, you start to scroll down, and on Thursday, I almost missed it, but you actually have a 30-year bond auction as well. This is the one that was the toughest before, but lately, I guess people have been buying this one, but this is the one you got to watch the most, right? Because people are like, ugh, 30-year bond, I don't know about that one. And then Friday, you'll have core PPI, which is what the Fed loves to look at and stuff. They're expecting an increase in the month over month, but a slight decrease in year over year and below the 2%, which is actually a key level to watch right there. And so it's definitely going to be a lighter week on economic data, Monday through Wednesday, and then Thursday and Friday will be really fun. But then, of course, from here on out, starting Friday of this week, it's just going to be a slew of earnings, right? And another thing you got to watch out for rotation back in the Max 7 is the dollar, right? It's been so weak that now, remember, they make over half their income from overseas. So when they get to convert that back into American dollars, it's going to look like, ooh, look at all this balance sheet and income statement looks great. It looks better, like there's a lot of growth, but actually they just got to keep more of it because the dollar was weaker, right? So it can cover up some things. And so that's another thing. And it depends on how many rate cuts they look at now, and then where they feel like the market needs to be. If you're only getting 4 rate cuts versus 6 and all that good stuff, right? So that's what we got to pay attention to. Anyway, good to be back and everything. Going to be recording normal as always. Kids back in school Monday, so it's a normal day finally. Normal week, that is. So looking forward to it. So if you got anything out of it, please hit that like and subscribe button. Really appreciate you guys, and I'll see you tomorrow.